2013 was a year when the economies around the world seemed to grow at a fairly decent pace, particularly here in the U.S. The question for us now is, what will 2014 bring? Despite the fact that in 2013 we saw a pickup in growth, particularly in the U.S., but also improvements in Europe and Japan, we don't think that we're yet at a point where it's off to the races. It seems to us that for every positive, for example, in unemployment, there's a negative, like the level of labor participation. While the Feds are accommodative and we think interest rates are likely to be kept fairly low, they have ticked up quite a bit lately, and you also have the concern about the level of the Fed balance sheet, not just in the U.S., but with the Eurozone as well as Japan. So it's a very much mixed picture as we look forward, and we think we will get decent growth in 2014 into 2015, but we certainly don't think that you'll get the kind of robust growth that you would normally find at this point in a cycle. Well, without a doubt, one of the important indicators that one has to be concerned about is, will the Federal Reserve and the various central bankers continue to be accommodative? And as a result of that, what will happen to interest rates? We saw some pretty big impact last summer when the Fed in the U.S. indicated that they were going to begin to taper. So what happens with the Fed? While we think it will continue to be accommodative, there's no guarantees on that. Importantly as well is what happens with the consumer. Usually growth is driven by a combination of business and consumer spending. At this stage, consumer balance sheets are substantially improved, but they haven't really yet stepped up to the plate and begun spending. And the same is true for businesses. Improved balance sheets, improved profit margins, but still we don't see the kind of investment in plant, property, and equipment that we'd like to see for sustainable growth in this economy. Well, there's no question that a change in Fed policy resulting in increased interest rates would certainly be a risk. It could slow things down significantly, if not cause real problems for the economy at this point. In addition, we've got to keep our eye on the consumer. Do they retrench? We've got to keep our eye on businesses. How are they seeing things going forward? And it's also very important that the world economy continue to grow. Even though things are at a slow pace, that growth has been improving. It's been improving exports in the U.S. Part of that is because of the increased competitiveness here in the labor market and in technology, etc. But if the world economies begin to slow, then not only will that have a negative effect on those economies, but it will also have an effect on the U.S. growth. "2013 was a terrific year. Numbers in the plus 30% range, even higher if you were invested in small cap stocks. We don't think that's likely to continue. It would be unusual, particularly at these kind of valuations, which are on the expensive side, to see those kind of numbers. We do think, given the positive momentum in the economy and given our outlook, that numbers in the high single digits are certainly possible. However, there's likely to be greater volatility. We're likely to see the kind of downdrafts that we had in mid-January with people selling on bad news. In 2013, the European and Japanese markets, when combined and looked at as the developed markets outside the U.S., underperformed the U.S. somewhat. Had good returns, but underperformed somewhat. In addition, the valuations, partially as a result of that, continue to be modestly attractive relative to the U.S. Finally, we think those economies may surprise on the upside. Most people expect them to bounce along without dramatic improvement. We think, therefore, that it might be a good time to overweight the developed markets outside the U.S. versus the U.S. The developing markets, difficult story. They're very different when one looks at one market versus another. Balance sheets are strained in some places. Currencies can be a problem. Interest rates are going to be a problem going forward, potentially. And we're not seeing the kind of growth pattern that we'd like to see out of those markets. So in developing markets, we're going to suggest that they will do okay and that one should move towards a target weight. but certainly not overweight. And remember that emerging markets are a long-term opportunity, and in the short term, volatility can be expected.